You might be wondering how to effectively trade the Falcon Effect strategy. You're not alone. There have been thousands of people that have tried to piece things together from afar. But in today's episode, I'm going to be giving you a rare gem. Now, if you're someone who trades the dollar cross pairs a lot, you're going to want to listen to this video. I'm going to be talking about correlation, how it matters, when it doesn't matter, and right now, why it's more important than ever before. And if you're someone who trades predominantly one instrument, so maybe just a euro dollar or a pound dollar, or maybe someone who trades US 30 or gold, these principles are going to be so valuable for you. So we're going to get into some chart work, some gems. This is going to be practical things that you can use straight away in your performance and start improving your trading results. Let's dive in. So what I've got here is euro dollar, and we have the DXY. I'm still astounded how people don't use the DXY to their advantage. So I want to show you how to use this in correlation. So euro dollar right now, you can see on the daily time frame, we've been tapping this area of resistance. You can see the gap has been filled. This is somewhat a significant area that we would look at for some sells. Why is it important on the DXY? Well, simple correlation. If this is going down, the DXY is going higher. It's not going to be candle by candle, but it does position you well just in case you're early to the party. So this is how I'd use it. Let's say, for example, right now we're looking for some sells on euro dollar. I would scale down to some lower time frames. Now I'm on the 1 hour. I'd then refine that to the 15-minute and then to the 5-minute. Let's say, for argument's sake, this is London session and the market is moving up towards this area right here, this value area. I would plot that on and go, right, ideally, I want to sell right here. So I'd position myself like this. I'll be looking for some sell continuations. Forget about the stop loss right now. Just like, this is the area that I'm interested in selling this market. So I would be positioning it like this, and price might be getting close to that pre-London session. Then I'll move over to the DXY. So by definition, if this is going to go down, DXY is going to go up. I can then scale to the DXY down here, and I can look at, well, have we hit the same significant area on the daily? Yes, I'm showing you here on the 4 hour, we've hit that. Great, so we're in an upward direction. Is there a clear target area for price to move above? Brilliant. Then this is the key part that people miss. I go into the lower time frames, and what you might find is, because it's not candle by candle, this is where traders get involved in trades early and they take unnecessary losses where my system would give you an advantage. And what that would look like is, and you can go and test this by the way, don't just take my word for it, you will see it. Let's say price is coming into a similar value area, because it is not going to be 1 for 1, but it's going to be very close. You might find that the DXY is moving off like this, but there is a gap, and the arbitrage is in that gap like this. So the gap would often look like that, where it nearly got there, but it wasn't significant. So what you found is the price got very, very close and it started to move away. And then what you're looking at is, let's say, price right here. So you're looking to sell, but you might be just a tad too early. There's 2 ways this works. Now you can either do 2 things. You can either stay out the market and wait, or you can just take euro dollar on its own merit. Well, all you need to do is go and test. How many times is when a trade is shaping up on euro dollar and euro dollar is correct, as in the criteria has been met, but there has been a gap on the DXY, is there any kind of correlation that you could look at of strike rate? So do you find a lot of your losing trades that you could identify this as, yes, the setup was genuine, but there was a little discrepancy on the DXY. You go pull that data up, that's going to arm you. That's the not as common one. The one in which that I find the most important is this here. So what would happen is the scenario would be like this. I'm looking to sell euro dollar. Prices come up to that area, like so, and then there is a rejection, but the rejection is on a lower time frame. So it's genuine, but it's still a little bit early. Now what happens is price on the other side would be coming in like this, that it's nearly there, same sort of thing. But let's say this is a 15-minute rejection. And in my trading plan, 15-minute rejections, they're still valid, but ideally a higher confirmation would be better. How would I then interpret this scenario? Well, I would look at the gap and go, hold on a minute, this could be a trap. This could be early sellers in euro dollar, and all this is going to do is manipulate that, show a short-term move up like that, and then come back in, take the low out, and then it's going to be the one that goes. And then what would happen here is I'm getting in on a 15-minute early, it takes it out, and then the real move happens. I think what is some of the most painful things, let me get this one to be a little bit larger. Let's blow this up actually. What is some of the most painful scenarios? Not the losses, because we all take losses, we take break-evens, we take wins. It's when you pick the direction right, and then you're just in too early, then it goes. How many of you have experienced that before? I can say to you with certainty, just understanding this correlation to see when that happens could be the difference of you using a more appropriate time frame to enable the criteria for you to get involved in the trade versus going, this is ready, I'm in the lower time frames. Bear in mind, I've been generous on 15. Many of you will do this on 5 minute, dare I say the 1 minute time frame, where you're not looking at where is the DXY positioned at the time in which that I'm taking a trade on euro dollar or pound dollar. Now it's going to be more weighted towards euro dollar, so we use this for the example. But what if that's the difference between a lot of your trades where you get in early, and sometimes you can use it from a sentiment point of view. So for example, let's go back to DXY. This has been so helpful for me over the years. Bearing in mind, I've predicted since 2017 almost every single higher time frame wave of the DXY. You can go back to all of my older webinars, say, yeah, I do know what I'm talking about when it comes to this. I don't have a crystal ball, but do I understand structure to a very, very high level that most systems don't? Absolutely. So let me show you. So if you go to the weekly time frame on the DXY, and why is this important to you from a dollar cross pair? Well, it gives you more of an understanding as to whether you should hold trades for longer or not. It gives you an understanding as to whether you're trying to buy in a sell market and you're taking counter trades, you don't even realize you're in them. So you've got to understand the bigger picture. Now, since the dawn of Falcon, since we started this project, we have successfully predicted these moves. These moves, these moves, these moves, these moves, and the more recent one, this gap being filled, and this move. You'll probably remember it on some videos I've done not that long ago. So why is that important? Well, I found that in this sell market, a big sell market, imagine you're on euro dollar and you're trying to get long, and you're seeing that, okay, I'm trying to get long in this time whilst the DXY is doing this. Would that be a good thing for you to do? Absolutely, because if by definition, if this is tanking to the downside to take out that low, what do you think is going to be happening to euro dollar? It's going to be moving to the upside. So now let's flip it. Imagine in a buying market for euro dollar, this is happening, but you're trying to sell it. Do you not think the quality of your trades are going to be decreased? Of course they are. But if you don't understand where the DXY is positioned, or you don't think it plays a role in your trading, you're going to take so many unnecessary losses, and you're going to mark them down as they were just losses. No, these were terrible losses that could be avoided if you knew how to utilize it. So what I want you to start doing is this. I want you to start more so focusing on it, not as a one-to-one, as like every position that you take, all the stars have to align perfectly. No. But what you do need to be doing, regardless of how you trade, whether it's one instrument or multiple, you need to know when it's important, the significant areas. So for example, significant area, big selling, significant area, potentially turnarounds of price. What about now? It's not as major, but it's still significant. Why? Because we're right at the lows. So even if the DXY is going to play this range, whether it be the middle of the range, which would be here, or the top of the range, which would be here, guess what? Short-term bullishness or medium-term bullishness, that means on euro dollar, we're going to see the flip side. We're going to see a lot more selling. So then if I go over to euro dollar, this is real basic, right? Yet so many traders overcomplicate this, and they'll try buying in this. So even though I've mapped out the correlation for you and it's so simple, they'll try and buy, and they'll be so zoomed in on, let's say, like the 5 minute time frame, and they'll think, well, look, London session, it's taking out a low of Asia, like whatever reason they've got, right? They're looking for a trade, they'll try and get long, and guess what? Tag them in, tag them out, and then they'll mark that on as, okay, that's just a loss, just another loss. So that marks on another loss, they do it again, another loss, and before you know it, I'm getting the messages saying, Mark, I'm minus 12 for the month. I'm not sure whether my strategy is working or not. And I would argue to give the strategy the benefit of the doubt. It's not so much that your strategy is not working. I just don't think you know how to trade it well enough. And I don't think even what's being taught to you, they know how to trade it well enough. Because what I've come to realize, 18 years, guys, 18 years in the market. Do you not think if there was the secret sauce out there that I would not only want it and I would want to be sharing it? So you don't think I've tested multiple different strategies across all time frames, all different instruments? Of course I have. At one point in time, I was just trading the DAX. So anything that you can share with me, I've already done and tested and saw whether is this long-term or not. Anyone can cherry pick a small situation of like, oh, let's use this strategy. Yeah, it's great, isn't it? Until it's not. And when it doesn't work, then what? Large swings of drawdown. That's not my cup of tea. I want robustness. I want sustainability. That's more important. So you need to understand where you're positioned in the market, how this could play a role for you. And there are things that you could avoid. So you might be in drawdown. I'm just saying you don't need to be in as much drawdown. So let's say your average swing of drawdown is -8. What I'm telling you is it could be -4. And then you have to ask yourself, how much is that worth to you to find out how you could mitigate that to only have a -4 versus a -8? Because the -8, dangerously close to you losing most of your funding across most funding firms of drawdown threshold. So yeah, that's pretty vital. So I thought I'd share that with you. Food for thought. You can go and test this on your own trades and you will see it. You will see it with your own eyes. I don't even need to explain it. So for us moving forward, really simple. Euro dollar, as of right now, we would be looking for sells and we'd look to play the short term and potentially all the way down to here. And we've filled those gaps. And I'm going to give you a model to follow as well. People often ask me, they try to identify, Mark, what's the Falcon system? Is it just, is it just flags? Is it just bear flags and bull flags? No, it's not. And anyone who's in Falcon will understand the sheer amount of intricacies that we go through to be able to mitigate that risk. I would argue, I could look at any strategy right now and tell you where you are going wrong, where a loss that you knew a long time ago, that trade idea wasn't working out, that would be right under your nose and you wouldn't even be able to notify it. But when I look at all of my trades and I look at my students' trades, I look at my coaches' trades, when I'm looking at that detail, we can see categorically, you should have got out there. This is why that happened. Like we know to the absolute T with absolute certainty when a trade idea is going wrong. And when I see people run at 3% and take a loss, insane. Even at 2-to-1. If you're running at 2% of profit and you still took a loss, you have a flawed system. Because, and I'll tell you why before you get triggered about it, I could look through, I'll do it for free. I could look through all of your trades, show me 20 of those, show me a sample size of 20 of those trades. I should not be able to dissect and go, this is how you could avoid that on almost 95% of those trades. I shouldn't be able to, right? You should be able to give a justification as to why it is better to take that loss than to take a break even. But I could show it. Any strategy, you can challenge it. Easy. Because there are certain things that happen structurally in the market that give you warning signs. This trade idea is not working out right now. And I'm going to go and margin that with, even if you take trades with a 7 or 8 pip stop loss, as long as it's not a 2 pip stop loss and you're not just an absolute moron, then it'll be fine. I can help you with that. But let me give you this really, really simple model. And if you want to learn more details on how to trade this model, because it's so effective, it's so repeatable, it's very methodical and systematic, that if you have this model with a higher time frame, robust narrative strategy, it's so difficult to fail, especially with prop firms and if you're someone who wants to scale up. And I've already kind of showed it to you, you've been paying attention. So what am I looking for? I'm looking for price to sell off, and this is the same in reverse. I'm looking for price to sell off. I'm looking for price to leave an area of significance where the bigger players have stepped in. That's usually going to be visible with a sharp move like this, or what it's going to be is a lot of consolidation like that. So what we're looking for is the price to leave that area, and then what we're secondary looking for is price to come back up and get near that area, but not touch it. Then we're going to move away. So we're going to come back up, and then we're going to move away. And then that creates the gap. So the gap happens here. And this is where the magic happens. And you might be thinking, oh, this is too simple. Yeah, it's so simple that you'll miss it. That's why you don't make money. So we've got the gap here, we've got price there. This is where the significant volume is. This is where the significant volume is, whether it's sharp or whether it's flat. Whether there's a huge consolidation, doesn't matter. Price has left that area, it didn't quite make it. So what's going to happen, and this is where everybody goes wrong with most systems, it's going to come up. But in the pursuit of it coming up, again, this is your counter trend trades that a lot of you will be doing in a sell market, which is a problem. So you're taking counter trend trades in the worst possible situation. and you're taking more and more losses. So meanwhile, you're taking the losing trades because you're trying to buy in correctly and you end up getting wicked out. So even though you pick the short-term direction correctly, you still lose, not realizing that price was moving towards that value area like a magnet. It was drawing price in. And as it draws price in, you need to be a sniper, not a machine gun. You need to wait. You need to preserve your capital. So then what happens? People sell early, they get trapped, and it's like -1, they lose. And at this point, they're demoralized and they're like, all right, walk away from the trade, don't trade anymore, in drawdown, stressed out. Then what happens? It fills the area, it fills the gap, and then it goes. It fills the area and it goes. Are there niche scenarios where it goes early? Yes. Is there timeframes that you should use to be able to know whether to get involved in that? Yes, and it's so simple. The problem is, if you're on too low a time frames, you will be caught in this trap over and over again. So you answer the question. You answer the question for me, or you be the judge. Do you believe that if I'm trading in a way, because people often say, "Oh, Mark, that just seems like it's too much guesswork, or is there some discretion?" They don't really understand it. I want to ask you the question: do you think that if price is doing this, and I say, "Hey, what I want you to find is an area where there's a lot of volume. I want you to find an area where there's a lot of volume, and I want you to find an area where something sells off from that area. And I want you to then find price getting near that area and leaving a gap. And then I want to see another sell-off. And then I want you to find price where it comes back up to fill that gap, to take out that high, and then it sells off to go in the opposite direction." Does that seem somewhat methodical or mechanical to you? Or does that seem random? I think if you have a rational brain, you will realize, yeah, that's pretty systematic. This is very regular. Exactly. So now imagine that tradable model and then correlation like DXY to euro dollar, or as a bonus tip, the JP225 to the yen pairs. Now, that's a YouTube video for a different day. If you want to know more about that, you can comment in the comment section and let me know. But that has been so favorable for us as well. It's not just about this correlation. There are certain correlations, in my opinion, are false. And I'll do a whole other video on that. Not important. These ones are important. But this model, once you know how to trade this model as a H4 model, a 1 hour model, a 15-minute model, a 5-minute model, if you want to be more aggressive, all of that I teach, but you trying to piece it together through YouTube, even if I put all the videos out there, it'd be virtually impossible for you to get consistent at it, because you need the source, you need the step-by-step, you need the regular commentary, you need me actually analyzing it every single week and going, hey, yeah, these were good, these are bad, for you to be able to figure that out. That could take you 6 to 7, maybe 10 years to do that by yourself. So if you're someone who's ready to get really educated, I've given you some gems and some free education and some clues. But if you want to get ahead from now until the end of the year, I encourage you to get involved. Like right now, our students are locking in, taking full advantage of this material and making sure by the end of 2025, the technicals are so up to scratch, they're scaling up their capital. So if that resonates with you, we would love to see you on the inside. I really hope this correlation video helped.